UVA Darden.
Good Disruption, a lively discussion between UVA Darden School of Business professors Yael Grushka-Cocaine and Mike Lennox on cutting-edge technologies and practices that are challenging the status quo.
Hello, Yael.
Hey, Mike. How are you?
I'm doing well. How are you doing this, cold or getting warmer February day?
Let me just say, I am so ready for spring. I cannot tell you.
All right. Well, I've got a question for you. This is going to be almost kind of a pop culture question, but I always feel more up to speed on these things than I am. Do you know who is Mr. Beast?
Mr. Beast.
Have you heard of this? And I've got one for you. All right. So this is a pretty famous influencer who got his start giving challenges to people.
Oh, maybe my kids have mentioned.
I am sure your kids know of Mr. Beast. Anybody Gen Z knows of Mr. Beast.
To it home.
$1 million prizes for doing crazy things. So here are some of my favorites. I spent 50 hours buried alive.
Yeah.
Like, would you want to do that challenge?
Okay.
He actually did Squid Game, like without the killing.
Now sounded very funny.
Yeah. Survived 30 days trapped in the sky. Like all of these challenges he does. The reason I bring him up today, because I want to talk about Fintech, which is something we've touched about crypto and some other topics in the past.
What's the link between Mr. Beast and
this
Fintech?
is the crazy thing. He just acquired the youth-focused Fintech app called Step here.
Okay.
And so Step labels itself as an all-in-one money app, banking for the next generation, already has roughly 50 million under management and 7 million users here. So this is like going after the younger generation, getting them into banking, providing a variety of sources. My first question is like, does the fact that a big influencer like this is buying a Fintech app company, has Fintech jumped the shark?
Well, I see it interesting and appealing because the direct-to-consumer kind of angle is all around us. I mean, big influencers are kind of on that wave, right? We're going to get direct in front of our consumers. We're going to find a way to connect with our followers and with the people that we're engaged with already and benefit from it in other ways. So I can see that going hand in hand.
But I mean, if everybody has their Fintech app now, if everybody's offering one of these, by the way, for our listeners here, jump the shark is a great Gen X reference. Do you know like where that phrase comes from?
No, where does it come from?
You don't know that phrase?
No.
You know the phrase?
I know the phrase.
Okay, so it's pretty much in our popular vernacular. So this is definitely one I remember growing up. So Happy Days, the show.
Yes.
There's a very famous episode where Fonzie, the cool guy, supposedly, they go to Hollywood.
Yep.
And he literally jumps a shark that's in the water and water skiing.
This is when they were coming up with content. Like
right. They were desperate.
Of the days of Happy Days.
And the best part of it was he wore his leather jacket as he's riding on the ski thing. So that is the reference to this idea that like the show really kind of lost its footing. Right.
Yeah.
Well, let me give you some numbers here on, first of all, traditional banking, right? $191 trillion in total assets here, 4.7 trillion in revenue. Big banks like JP Morgan at 4 trillion, Bank of America at 3.2 trillion here.
Well, Mike,
that's the overall banking industry. Yeah.
Because banks, I mean, we all know banks, whatever generation.
Yeah.
Tell me, what is appealing for the younger generation? Why do we even have to innovate in this space? Why can't they just use the same banks that I use, the Bank of America, the Wells Fargo of the world? Why does the new generation, the Gen Z of the world, why do they need a new type of banking?
So, this started a little over a decade ago where we started to see the emergence of all these startups that were picking apart various parts of the value chain for banking here. And I think the arguments would be everything from efficiency to cost savings to kind of ease of access to the market. So what are some of these? And I know you know many of these. So if you think about replacing your kind of standard checking account, you have companies like Chime. Chime, if you're not aware, is an application that layers on top of an actual bank. So they're not really a bank like you typically would have for your savings and checking account, but they're providing a very fluid service using a mobile application.
So it's a little bit like our Venmo. The Venmo in and of itself is not necessarily a bank, but it's much easier for me to give you or transfer you some money than even going into my bank.
And as you can imagine, when Venmo first came out, I remember it as a way to split a check, right? So it was always hard and somebody had to pay and then you have to have, nobody had cash and the like there. So you have Venmo as kind of your wallet. Robinhood, do you know of Robinhood? So now, every person can go and trade stocks. My daughter had a Robinhood account for a little while, was scared the heck out of me as a parent. I'm like, please do not be shorting something or anything like that. Thankfully, she closed down her Robinhood account. There's companies like Affirm in the credit card market. So definitely appealing to that like Gen Z, but there's also others like just underbanked people who some of these products are going towards.
So products that maybe don't rely on the same type of credit score infrastructure that we're so used to kind of building on, the same kind of approval process that you would need and getting access to folks that maybe couldn't otherwise.
And I think this is where the tech piece comes in. I think so many of these at their heart of them are leveraging data to be able to do risk modeling in maybe a more expansive way, a more inclusive way. And then again, these kind of operational fees that can be cut down here. Some of it in like international transfers of money and the like, just some of these kind of, dare I say, almost archaic processes that we have for banking. They're trying to kind of break that down and make it easier.
So should we be nervous about our kids potentially getting access to some of these services, or maybe they're actually going to improve everybody's life? I mean, I remember when we did our episode what seems like a long time ago about cryptocurrency, we had this notion that some of the tension was from intermediaries or kind of centralized organizations that maybe were taking certain percentages in terms of interest or taking certain services, fees, and maybe the world is done with that. We want services that are much more accessible without paying extra fees along the way. Is there an opportunity for that from the market perspective, or is this all stuff that we shouldn't trust?
No, I think that's exactly the debate, right? On one level, you could say, well, what are the banking alternatives? Sometimes it's like payday lenders and things that have, dare I say, in some cases at least, been very exploitative. Right. So this is saying, no, we're making this easier. We're leveraging technology.
No more 40% rate on your card.
Right. You don't have to go to a store to like cash the check and all of these kind of old school processes. That's the promise. But I think you're absolutely right. Like, there's so many of these out there. Some of them, depending on how they position themselves, fall in these kind of unregulated spaces here. Right. How is that going to lead to potentially for those who might, again, exploit in other ways? I think about, being able to be a broker and being able to trade and things like that could be very detrimental for certain users.
Well, when we think about a disruption, so good disruption, our podcast here, we like to focus on disruptions, technological disruptions. Are you seeing that play out? Like, are banks being disrupted? Are we hearing about companies or organizations that used to exist that now future is questionable, or is this just more players in this big market?
That's a really great question, because usually when we think about these disruptions, we think about companies going out of business,
right?
Incumbent companies struggling with this.
Exactly.
I don't know for sure, but I think Chase is doing fine, right? I think Bank of America is doing fine.
You mentioned JP Morgan?
JP Morgan, yeah.
They're struggling from this perspective.
Right. But I do think it's fair to say that they've lost certain income streams that they had, or at least they've shrunk as these applications and the like have come up. So I think it's been disruptive in that way. One argument is the biggest disruption here might be customer acquisition, right? That this is lowering the cost of customer acquisition compared to the traditional, advertisements, show up to the bank, sign up for a service here. But whether it's going to be disruptive in that bigger way, I think is an open question, especially since one of the more recent trends is these very specialized players have now started to vertically expand or horizontally expand into other services. So will Venmo start competing with Robinhood here in the near future? And at what point do they just start to look like the Bank of Americas of the world, where they have a large portfolio of services they offer you as a customer?
I can see that.
Have we reached the limits of our knowledge? And,
we have.
All right.
We need to learn more to understand if this is.
It is time to bring in our expert Ian Appel, one of our professors here at the Darden School. He's also the academic director of our Mayo Center for Asset Management. He holds the John McFarland Family Chair. He studies a number of different things in this space, including institutional investors, corporate environmental behaviors, and governance and decentralized finance. But he has a particular interest in the fintech world. And so we're so excited to have you with us, Ian. So maybe to start off with, what have we gotten wrong and what have we gotten right so far?
I think you guys are on the right track. And so I like in particular how you highlighted sort of the uncertainty that exists with a lot of these new financial institutions, and particularly when it comes to potential risks that they might pose, but also how they benefit customers. And so I think that's a really important point when it comes to thinking about these institutions.
I'm so excited to talk to you because I hear students raving about your fintech course. So clearly you're an expert and you get them excited about it. Is this like innovation that is technological in nature, or is this rethinking the kind of some of the rules of how to kind of think about money and how to think about our banking in terms of the products that people might be interested in? So is there a tech component to it, or is this something that is more theoretical and almost like a economic in nature?
So both. And so let me explain. For instance, Mike was talking before about some of these new banking models. For instance, Chime, this idea of a neobank. And fundamentally, neobanks, they use some new technologies, they integrate APIs, but everyone does things like that today. Really, it's a new type of business model. And so, for instance, what a neobank like Chime is doing is that they are partnering with a chartered bank that takes deposits. You need to have a bank charter in order to take deposits. And Chime is providing the front end. Chime is the brand. Chime is providing some other infrastructure. But it's really bringing this new business model to banks. And so this is an interesting thing because, well, rather than competing with some of these smaller banks that Chime partners with, they're actually partnering with them. And so that's sort of one side of what we see happening with the evolution of banking. But certainly part of this story is also technology. And so we see new fintech startups are applying technologies like machine learning, AI, when it comes to underwriting loans, when it comes to predicting the riskiness of borrowers. And so we see really both of these things happening simultaneously and shaping the future of banking and how the industry is evolving.
You know, when I think about the competitive dynamics between like the established banks and these fintech entrants, it comes to mind Venmo and the success they had, and then the consortium that formed Zelle as like an alternative which really is the traditional banks who are running the show there. What's your prediction of how this is going to evolve? Like, is fintech going to be swallowed by the big banks at the end of the day, or do they have some form of competitive advantage that's going to allow them to kind of survive and succeed in the face of these big banks?
I think it's a really interesting question. And in part, it's useful to think about the US versus other countries. And so I think in general in the US, people tend to be relatively happy with their bank. And so when you look at approval ratings, people hate certain types of companies. People don't like Comcast in general. Banks, actually, people tend to be pretty happy with their banks. And you see that some of these neobanks, banks like Chime, they've made progress with certain subsets of the population, oftentimes lower income folks. But we see by and large, JP Morgan, Bank of America, banks like that, which were dominant when Chime came out 15 years ago, remain dominant. Now, it's interesting to look at other countries where, for instance, if I poll my students and I ask them, does anyone use Chime? And generally, no one does, at least from the US. But then if I ask students, particularly those from Europe, do you use Revolut? And there you see almost every hand go up for those people from Europe. Same thing with Brazil, where Nubank is incredibly popular and has really made progress in terms of taking market share from incumbents. And so this is something that is localized to an extent. In the US, I agree with you. The big banks were dominant 15 years ago and remain so. In other countries, we do see fintechs really making progress.
Well, it's interesting. I'm part of me is also trying to learn from Mike over the years from this podcast, like how to think about disruption. So I use Apple Pay everywhere that take it. Like I just typically only travel with my phone these days. I don't even need to take a wallet anywhere anymore. So like, are we really talking about a transformation or a kind of disruption here? Or are we talking another layer of ease that we now had?
And that was going to be my question, kind of directly on that, like these payment apps, either from Apple or from Google. But I also think about what's happened overseas with some of these companies like WhatsApp and their use of these kind of one-stop shop applications for everything people do, communications, banking, and the like. Is that ultimately could be disruptive for the traditional banks, Ian? Or again, is it going to be like currently where I'm using other banking services through my Apple Pay and the like?
I think a goal that many fintech companies have in the US today, as well as the rest of the world, is going after sort of the Alipay super app model. And to be not only the center of your financial life, but other aspects of your life as well. We've seen that it's very difficult. And this is why you see, as you mentioned before, some of these fintechs are integrating more and more services. You start with one particular service. Maybe you have you can make payments more efficient, and then you start layering on accounts, or you start layering on lending or peer-to-peer transactions or something else. And really, everyone wants to sort of take that idea of be the center of consumers' financial lives. And you've seen this work in some places. In the US, though, many companies are going after this. I'd argue you really haven't seen any company be terribly successful.
What about on the investment side, like the Robin Hoods of the world? Are they all going to run after that part of the market as well? Like suddenly I'm going to have my checking account and I can also choose where the monies are invested while I am letting my money sit there?
I mean, I think absolutely. And so SoFi is a case in point where SoFi started out, it was loans to students. Over time, SoFi adds more and more services. They eventually actually obtain a bank charter. SoFi becomes a bank. And now they have services like crypto. You can trade crypto on SoFi. You can trade stocks on SoFi. And you see more and more services being integrated. Likewise, if you start with Robinhood, Robinhood's going sort of trying to reach the same point, but approaching from the opposite direction, where Robinhood starts out with, okay, well, you can trade stocks and options. They add in crypto trading, but now Robinhood is offering savings accounts. Again, sort of approaching that idea of we want to be the center of your financial life.
Interesting. Like my E-Trade has grown over the years in my use cases of it. Ian, can you define this idea of a neobank? Like what is a regular bank versus a neobank?
So typically when people use the term neobank, they're thinking about a digital-first institution, which some neobanks have a bank charter. So Nubank's an example where they actually are a regulated bank. Revolut has a bank charter in Europe as well. Some don't have a bank charter. And so that's the Chime model that we defined before, where they work with a partner institution. The key features are digital first, typically not having any sort of physical branches. And then notably when fintechs like Chime first came out, they were known, one of the key differentiating factors was the app that they had. And so Bank of America, Wells Fargo at the time did not have a very good app. Chime came in and said, hey, we're going to have a nice app that you can use on your phone. Today, that's not really a differentiator, but Chime being sort of branchless is sort of one of the key differentiating factors from normal banks.
I want to get back to the competition piece here because one of the things we saw, for example, on online retail that I always like to highlight to my students is creating incredible efficiencies in the marketplace, allows consumers to comparison shop very easily, has a great impact for consumers that it tends to drive down prices, and ends up being a terrible business for most of the online retailers because any type of competitive advantage is competed away. You get a not quite, but close to a perfectly competitive market.
Right. Battle to the bottom.
Bottom to the bottom there. Yeah. Is that going to happen with banking here? I mean, as you get these efficiencies, as you create lower barriers to customer acquisition, but barriers to entry for these companies to come in, is this going to just make banking just thinner and thinner and thinner margins?
I think you see it happening in some corners of banking right now. And so if you look at one particular service, take cross-border transactions. And so this has long been a concern, particularly with things like remittances. If you want to send money from the US to India, the fees for sending something like $100 are typically very high. You're talking on the order of like 5 or 6 percentage points, something like that. You have a wave of new fintechs that are coming in and competing on price, employing new models. And so Wise is introduced a new model where they said, rather than using the typical correspondent banking system, this is the way that banks transmit money. There's essentially a chain of banks to transmit money across borders. Wise said, we're going to do these transfers internally. We can essentially make it much, much cheaper and nearly instant in order to transmit money across seas, overseas. Well, more and more companies are adopting these models, and there's competition on price now. Now, Wise actually says that their goal is to make cross-border transactions free or almost free. And so that's sort of a weird word when you're thinking about, well, this is a publicly traded business. They're trying to make money. Usually don't think about offering your service for free. But this in part explains why Wise is expanding its product offerings, particularly with offering Wise accounts. And so they essentially offer savings accounts for individuals. Now, the key thing that a savings account allows Wise to do is they can offer cards. And so particularly with debit cards, this is where actually the revenue growth for Wise has been coming from. If you look at the last year or two, it's not actually from their main business of cross-border transactions. It's from offering debit cards and getting fees associated with their use.
Fascinating. So I can see that slowly taking that away from the major banks, but maybe something like something that is maybe more regulated. You know, we had the financial crisis in 2008-9. Like, I cannot imagine that suddenly we can get mortgages from some of these services if they're not as stable. Like, is there a concern there that?
Maybe to frame it as, are we seeing regulatory changes for the banking sector as a result of these other opportunities? Or are we still kind of clinging to these old regulatory structures for a different era?
Well, I think at the end of the day, regulation explains why some of these models are being adopted. And so particularly if you're thinking about a bank or a neobank like Chime, well, a natural question is, why doesn't Chime just get a bank charter? Well, banking's probably the most regulated industry in the world. And the reason is because of things like the financial crisis, where if you are a deposit-taking institution, you need lots and lots of regulation, because we know that, well, deposit-taking institutions, they can fail sometimes. Sometimes they can have a bank run. That's why we have a huge regulatory system around these institutions. And so neobanks, particularly those that don't have a bank charter, say, hey, we're going to let a partner bank deal with a lot of that regulatory side of things. Now, of course, there's still some regulations around, you have to know who your customers are and protect against money laundering and things like that. But when it comes to the actual deposit taking, that's why Chime says we're going to let someone else handle that aspect of it.
So on the back end of this, does this create more risks? And I'm thinking, maybe not the right comparable, but like the creation of credit default swaps during the lead up to the 2008 crisis. Are there things to be worried about as these different players come into the banking system of increasing systemic risk in some way?
The thing that we're most worried about, which is sort of the banking side of things, given that you have to partner with a regulated institution that has oversight from, the Fed or the OCC or, one of these regulatory agencies, I think that helps to protect against some of the risks. Arguably, the risk that people think about a lot when it comes to fintech is protecting consumers. And so an example of that is, we mentioned before, some of these new fintechs, they employ new technologies when it comes to pricing risk and making loans to individuals. And so part of this is they use data to make lending decisions that a typical highly regulated institution would not use. And this raises questions about ultimately fairness. Is the use of new types of data really fair to consumers or not? And so that's one risk that I think lots and lots of people are worried about.
Yeah, but then maybe in a way, could it be, Ian, I'm just thinking and reacting to this, could it be that with an abundance of new players, and yes, maybe a little bit more of kind of an opportunity for new types of models to emerge, maybe we're diffusing some kind of risk as opposed to it being concentrated in very specific institutions? I mean, you still have that underlying regulatory kind of authority, but maybe it actually kind of provides an additional protection in some kind of ironic way.
I don't know. I'm going the opposite direction. I'm thinking,
Happy that it's not all in the hands of the same one businessman in charge of one bank.
But I think to your point, Ian, like you're right, that diversifies the opportunities. You can choose your risk profile, but that assumes some degree of knowledge by the consumer.
By the consumer.
And that there could be people who have no idea. I imagine on some of these products, they might not be FDIC insured. I don't know if that comes up at all, but this idea that like, you might have certain beliefs about what you're doing, and in fact, those aren't lining up.
Yeah. It's interesting how knowledgeable folks are in terms of the differences between these different modules and who are you getting your money from and what protections are there, or who are you giving your money to,
right?
More importantly.
And we're in a world where we've been opening up more and more of these investment opportunities. It's probably a separate podcast that we can talk about gambling apps. But I mean, the fact that we've just gamified and gambled on everything now, and how does that affect consumers, thinking about their investments?
Well, I know that we've had some concern about crypto before.
Yeah.
Ian, is it fair to say that we should kind of decouple crypto with fintech? Fintech is a lot more than just crypto. I'm hearing from you. We're not just talking about crypto, but like if crypto continues to be rocky or volatile, will that affect where fintech goes necessarily?
Yeah, so fintech is certainly much broader than just crypto, and it wasn't until now we even brought up crypto. I will say, though, that the one aspect of blockchain that is sort of becoming very quickly mainstream in all of fintech is the idea of a stable coin. And so having a crypto that isn't volatile like Bitcoin, the price isn't doing crazy things, where the goal of a stablecoin is just to maintain a $1 peg, have a steady value of $1.
So the concern with those have been regulatory, right? Because we've had these examples of companies that have claimed to have stable coins, and then they look under the hood and there's like no assets backing up their claims. Or Terra famously coming up with a synthetic stable coin that proved the model did not work. Are we figuring that out? Is it government issued stable coins that are going to be the solution there, or will it be a private entity who does it?
So right now there's been regulation in both Europe and the US to essentially create rules for stablecoin issuers in terms of what assets do they need to hold and who's going to check to make sure that the assets are actually there. And so with the Genius Act in the US, it essentially says these stablecoin issuers, if you want to have a Genius Act compliant stablecoin for use in the US, you need to hold short-term government debt, and you need to have it daily. You have to have this audited to actually show that if you say you have X number of stable coins in existence, that you have the same amount of assets in very safe government securities backing it up. And so they're trying to create a system here where you can have stable coins produced by these private companies, but make sure that they're safe and consumers are protected.
That reminds me of something we often talk about with disruption, that sometimes the regulatory apparatus, it just lags by its very nature, but we eventually get there. I mean, I'm old enough to remember the old savings and loan crisis of like the late 1980s, where again, there were really good checks to see how they were investing our checking and savings accounts in those vehicles.
Well, I'm hearing that there's some technology innovation here, meaning the apps, the use of our phones, the just the general kind of comfort with that, with everything being done digitally, the advancement of AI and machine learning, which we've been talking about in so many different ways. I heard, Ian, you allude to the business model innovation. So because we have new technology and speed of access, that comes with a new business model, as you and I kind of often talk about. So I can understand where the disruption is kind of emerging, both in terms of the processes and in terms of the tech. What about, obviously, opportunity opportunities and risks, not just in terms of the collapse of the financial kind of structure, but, fraud and things that happen online that are more easily kind of penetrable than, if my money is in a safe physically somewhere, if I can ever imagine that to be the case.
I was going to say, I don't think that happens anymore, Yael, but you tell yourself your money is sitting in a safe somewhere.
Now everything is digital. Like, how easy is it to see suddenly some problems with data and some security issues over there?
Security is certainly a risk for any sort of financial application. I will say that arguably one of the main applications of sort of AI and machine learning in finance today that has seen the most success is using it to fight money laundering. And really looking at the characteristics of different types of transactions that might indicate that someone is engaged in some sort of illicit behavior. And so if anything, if you think about sort of the massive quantity of financial data that these financial institutions are dealing with, being able to comb through that and sort of pick out the key characteristics that might indicate that this is sort of money laundering or, funding some sort of illegal group or something like that, is very powerful.
And
I watched Ozark. Have you ever watched Ozark? Everything I know about money laundering, I know from Ozark.
Big fan. And they got it down to a T there. But so cyber threats are kind of any concern there. I will say that it feels to me like our banks are, even the regular traditional banks are much quicker and faster to act upon anything that looks like any, detecting any anomalies in our card and our behavior. So is that
the incentive to do that?
They do, but that's also feels like I feel more protected in that sense. So are we kind of comfortable with that, or with this new bank?
I guess what went to my mind, have we seen examples, Ian, where someone has basically set up a nefarious fintech, like, hey, we're the, Chimes with like an S on the end, and they're like fooling people to sign.
A surfer in the field.
Yeah. Has there been anything like that we've seen?
Well, so if we think about crypto, you see things akin to that happening, where you see very fraudulent behaviors and sort of tricking people to give away their money. And the key differentiator of when we think about crypto is that because it's not using traditional payment rails, it's using a blockchain to move things around. It makes it so that funds aren't recoverable if someone steals money from you. There is no sort of recourse in terms of how to get your money back.
I find it fascinating. There's been these cases where the FBI have arrested people because the problem with crypto is that, like, let's say Bitcoin, it's not often used for transacting. Right. So you need to convert it into something useful. And it's when they convert it, it comes back into that normal banking system, and they get them right away. They literally will sit there and watch these accounts knowing that there was something nefarious, and they wait for them to try to transfer it out to then pounce on them.
Fascinating. Well, this is exciting. I think that there are so many ways in which I can imagine this improving our lives. I see the ease in which my kids are more independent, and going back to, that younger generation, they find money and talk about even investments and even, buying and trading stocks. Like, they find all of this more accessible, and that maybe is a good thing for self-awareness.
And I'll go with the efficiency side, the fact that this could be lowering the operating costs, getting some of the stickiness out of the system. Like I said, it might not be great from a competitive standpoint, but it might be great from a consumer standpoint, obviously, and lowering those costs there. Yeah. Well, Ian, thank you so much for joining us today. At this point, we're going to transition to our last little point where Yael and I debate the big question: good, bad, or no disruption. So where are you coming down, Yael?
I am somewhere between no disruption and good, meaning I'm not quite convinced. Definitely there's development and there's kind of modernization, and I can see it. I use it myself and I can see it. But I think that it's happening at a pace that the incumbents are embracing it too. And so I think it's kind of feeding into the ecosystem as opposed to completely changing it. Does that make sense?
Yeah. So what you're going to go for? Good or no?
I'm going to go for no disruption.
Ooh, excellent. Yeah, your thinking is exactly aligned with mine. There are some downsides. Obviously, I don't see it being so overwhelming that I'd worry for a bad disruption case. But I agree. Is this a more incremental innovation that helps improve the banking system? Thinking back to like the existence of ATM machines and other technologies that have helped improve banking, but maybe haven't fundamentally changed the nature of it. Just to be contrarian, though, I'm going to go with good disruption.
All right.
I'm going to go, it's going to be a disruption, at least at some level, but a fairly muted one. Again, I'm not sure the Bank of America is, eminently going out of business here because of the rise of Venmo. And
Although if I have to trust Zelle anymore, then I may have been a little bit more concerned. But yeah.
All right. Well, with that, thank you all for being with us today. As always, we thank our producer, Gary. We thank our lead researcher, Becky. This is Good Disruption. Have a great day.
Thanks, Mike.
Good Disruption is a podcast from the University of Virginia Darden School of Business.
Darden.